Picture this. It's 1965. You just bought control of a company that's been losing money for years. The smart move? Sell everything and get out. Warren Buffett had a different plan. He was about to perform the greatest magic trick in business history: watch a textile mill disappear. In its place, an insurance empire, then a candy company, then a furniture store, then stocks that would make people billionaires. Buffett didn't just change Berkshire's business model, he changed what it meant to be Berkshire. This textile business had been running since 1839. Buffett took control in 1965. This wasn't a turnaround, this was a complete resurrection. But here's what most people don't know about how it all began. Warren Buffett's entry into Berkshire wasn't part of some grand strategy. He stumbled into it by accident. It's 1962. Warren Buffett is running a small investment partnership from his home in Omaha. He's 32 years old, still hungry, still proving himself to investors who trusted him with their money. Every morning, he scours financial newspapers looking for bargains, companies trading below what their assets are worth. That's when Berkshire Hathaway catches his eye. Buffett began buying shares in 1962 at roughly $7.60 per share. By 1965, his partnerships had paid about $14.86 per share, while the company's working capital was roughly $19 per share. This is exactly what Buffett lives for, a classic value play. Here's what most people don't know about young Buffett. He wasn't some patient long-term investor yet. He was running a hedge fund. His job was making quick profits for his partners. Buy cheap, sell when the market realizes the mistake, move on to the next bargain. Berkshire seemed perfect for this strategy. The textile company had been around since 1839. They owned mills in New England, real estate, equipment, and inventory, all worth more than the stock price suggested. But this wasn't supposed to be a takeover. Buffett just wanted quick profits from an undervalued stock. The plan was simple: buy shares while they're cheap, wait for management to unlock value, sell when the price reflects true worth. Maybe make 50% in a year or two, then find the next opportunity. But Berkshire kept disappointing him. Management would promise improvements, stock buybacks, better operations. Then, nothing would happen. The promises turned into excuses. The excuses turned into more promises. Month after month, Buffett watched his investment stagnate. The textile business was brutal. Foreign competition was crushing American mills. Labor costs were rising. Profit margins were shrinking. Yet management kept talking about turnarounds that never came. Then, everything changed. CEO C. Barry Stanton made a move that would haunt both men forever. Stanton offered to buy back Buffett's shares. This was exactly what Buffett wanted, a clean exit from a frustrating investment. They agreed on a price of $11.50 per share. Buffett said yes. He was ready to walk away. But when the official tender offer arrived in the mail, Stanton had changed the price. 11 3/8, just 12.5 cents less per share. The broken promise felt like a slap in the face. Most investors would have shrugged, taken the money, moved on. Warren Buffett felt something else: rage. Here was management breaking their word over pocket change, trying to squeeze him for pennies after months of broken promises. The disrespect stung more than the money mattered. Picture Buffett sitting at his desk, holding that tender offer. He could sell his shares, take his modest profit, find a better investment tomorrow. That's what the old Warren Buffett would have done. Instead, he made a decision that changed everything. He rejected the buyback offer. More than that, he decided to buy control of the entire company.
This part of the program is sponsored by The Tria, oasis of comfort with a touch of luxury. Visit thetria.com. Your dream home vibe is just a scroll away.
This wasn't about textiles anymore. This wasn't about quick profits. This was personal. Over the next few months, Buffett quietly accumulated Berkshire shares. He convinced other frustrated shareholders to sell to him instead of back to the company. By 1965, he owned enough stock to force out Seabury Stanton and take control of the board. He replaced management and named Ken Chase president. What started as a simple value play had become a hostile takeover. What began as a quick flip had become a permanent commitment. So what was Warren Buffett's original plan? He never intended to own Berkshire. It was supposed to be a quick flip. Instead, wounded pride and a CEO's broken promise turned him into the owner of an entire company. Looking back, you can see the irony. The worst decision Seabury Stanton ever made created the greatest fortune Warren Buffett ever built. But taking control was just the beginning of his problems. Owning Berkshire meant owning a company that was bleeding money in a dying industry. Buffett would later call the textile business his worst trade. Think about it. Here's Warren Buffett, already known for his investment genius. He's just taken control of Berkshire Hathaway. His partners are watching. His reputation is on the line. And the business is hemorrhaging money every single month. The textile industry was facing a brutal reality. American mills faced significant labor cost disadvantages from lower-cost foreign competition. The math was simple. The outcome was inevitable. But Buffett refused to accept defeat. He poured money into new machinery, hired better managers, and closed inefficient plants. Nothing worked. Every year brought more losses. Every year, foreign competitors got stronger. Every year, American textile companies shut their doors for good. Berkshire was fighting a war it couldn't win. Here's where it gets heartbreaking. Buffett watched his employees lose their jobs anyway. Families who had worked in these mills for generations. People who depended on Berkshire for their livelihoods. The very workers he was trying to save. Picture Buffett in those board meetings, reviewing another quarterly loss, signing more layoff notices, authorizing another expensive equipment purchase that might keep the mills competitive for a few more months. His value investing principles screamed at him. Cut your losses. Move your capital somewhere profitable. Stop throwing good money after bad. But something deeper kept him fighting. Maybe it was pride. Maybe it was loyalty to the workers. Maybe it was the stubborn belief that American ingenuity could overcome any challenge. Whatever it was, it kept Buffett writing checks to fund a lost cause. The numbers tell the story. Berkshire's textile operations lost money in 1966, and 1967, and 1968. Every single year the losses mounted. Every single year Buffett hoped next year would be different. The market didn't care. Department stores wanted cheap fabric. Clothing manufacturers needed low costs. Consumers chose affordable clothes over American-made ones. The economics were unforgiving. But here's the twist nobody saw coming. Buffett's biggest mistake was teaching him his most valuable lesson. Every dollar he wasted trying to save Berkshire's textiles was a dollar he couldn't invest in profitable businesses. Every year he spent fighting foreign competition was a year he lost to compound growth elsewhere. The opportunity cost was staggering. While Buffett poured millions into failing textile mills, the stock market was creating fortunes. Growth companies were exploding. Insurance businesses were generating steady profits. He was missing it all.
This part of the program is sponsored by Via Nature, where nature meets innovation. Visit vianature.com. Your planet-friendly goodies are just a click away.
Think about the internal battle raging in Buffett's mind. His analytical side knew the textiles were hopeless. The numbers didn't lie. Foreign labor costs weren't going up. American wages weren't going down. Technology couldn't bridge that gap. But his emotional side felt responsible. These weren't just assets on a balance sheet, they were people's lives. Communities built around these mills. Generations of families who had nowhere else to go. The final blow came when Buffett realized something devastating. No amount of capital could save American textiles. No brilliant strategy could overcome massive labor cost disadvantages. No management team could perform miracles. He was fighting economics itself, and economics always wins. Berkshire's last textile operations were closed by 1985. 20 years of struggle. 20 years of hope. 20 years of watching an industry die despite his best efforts. Buffett finally accepted the truth. He had spent over 2 decades and millions of dollars trying to save an unsavable business. The opportunity cost was enormous. The emotional cost was worse. Years later, Buffett would reflect on this period with brutal honesty. He called it his worst investment decision, not because he lost money on the stock, but because he wasted years trying to resurrect something that was already dead. Buffett later said the chief cost wasn't the money lost, but the time and opportunity cost. Time and capital he could never get back. Lessons learned the most expensive way possible. But sometimes, the worst mistakes force the most radical solutions. By 1967, Buffett was ready to try something completely different. In March 1967, Buffett wrote a check for $8.6 million and bought National Indemnity Company. This wasn't just another acquisition. This was using a 128-year-old textile company to deliberately reinvent itself as something completely different. Picture Warren Buffett sitting in his Omaha office. Stacks of financial reports covering his desk. Another quarter of textile losses staring back at him. But instead of writing another check to save the mills, he does something shocking. He uses Berkshire's cash to buy an insurance company. National Indemnity wasn't glamorous. They sold car insurance in small Nebraska towns. Basic coverage for farmers and working families. Nothing fancy, nothing complicated. But Buffett saw something others missed. Think about how crazy this looked. Berkshire Hathaway had been weaving fabric since 1839. Generation after generation of families worked those mills. The company name meant textiles. The brand stood for American manufacturing. Now their new owner was buying car insurance? Financial analysts were baffled. What did Warren Buffett know about insurance? How did this fit with turning around a textile business? Was he just desperate to find any profitable investment? The trade publications couldn't figure out the strategy. Insurance Week wrote confused articles about the acquisition. Textile World wondered if Buffett had lost focus. Investment newsletters questioned whether he was abandoning his core business. But here's what nobody understood. Buffett wasn't trying to save Berkshire anymore. He was trying to replace it. This wasn't just changing business lines. This was abandoning everything Berkshire had been for over a century. Most CEOs would have kept the insurance company separate, created a subsidiary, maintained clear boundaries between textiles and insurance, preserved the original identity while exploring new opportunities. Buffett did the opposite. He started moving Berkshire's best capital into insurance and other investments, shifted management attention from mills to policies. The textile mills wouldn't close completely until 1985, but the transformation had begun. The metamorphosis was like a butterfly emerging from its cocoon. Everything changes while the DNA stays the same. The textile workers felt betrayed. The insurance employees felt confused. Shareholders didn't know what company they owned anymore. Was this Berkshire Hathaway, the textile manufacturer? Or Berkshire Hathaway, the insurance company? Buffett's answer was revolutionary. It wasn't either. It was becoming something entirely new. He started viewing Berkshire not as an operating company, but as an investment vehicle. A shell that could house any business. A platform for buying whatever opportunities emerged. The name would stay. The headquarters would remain in Omaha. But the essence, that could be anything. This thinking was decades ahead of its time. Today we call them holding companies, conglomerates, investment platforms. In 1967, most people had never seen anything like it. The boldness was staggering. Imagine walking into a 130-year-old family bakery and announcing you're turning it into a tech startup. Keeping the name, keeping the building, but replacing everything else. That's essentially what Buffett did. He kept Berkshire's corporate shell while gutting everything inside. The stock ticker stayed the same. The legal entity remained intact, but the actual business? Completely different. Wall Street hated uncertainty. Investors wanted clear categories: textile company or insurance company, manufacturing or financial services, growth stock or value play. Berkshire refused to fit any box. It was becoming something unprecedented, a shape-shifting entity that could morph into whatever offered the best returns. The genius was hiding in plain sight. While competitors stayed locked in their industries, Berkshire gained ultimate flexibility. Textile margins getting squeezed, move capital to insurance. Insurance markets becoming saturated, buy a candy company. Always chase the best opportunities.
This part of the program is sponsored by Pause Wars. Gear up for happy tales. Sniff out pausewars.com, where your pet's wag comes with a splash of style.
Charlie Munger formally joined Buffett at Berkshire in 1978 and became vice chair, which would later influence Berkshire's capital allocation focus even further. This identity shift would enable everything that came after: the insurance float, the stock investments, the acquisition sprees, the massive wealth creation. None of it would have been possible if Buffett had stayed committed to textiles. But the transformation required abandoning 128 years of history, letting go of everything Berkshire had been to become everything it could be. Buffett had transformed Berkshire from an operating company into a holding company, a platform for capital allocation instead of a manufacturer of products. But this identity crisis was about to become Berkshire's greatest superpower, because Buffett had stumbled onto something most investors completely missed about the insurance business. The insurance business was actually a money machine disguised as boring paperwork. Here's how float works. Customers pay premiums up front. The insurer invests that money until claims must be paid. It's like getting an interest-free loan from every policyholder. Picture this scenario. If a company collects $10 million in premiums but pays $8 million in claims later, that $10 million sits invested in the meantime. The investment returns often exceeded the insurance profits by huge margins. Float is powerful only with disciplined underwriting and smart investing, and Berkshire excelled at both. National Indemnity was boring on purpose. They insured good drivers, conservative risks, predictable losses. The premiums covered claims with money left over. That leftover money became Buffett's secret weapon. Every new policy created more float. Every premium payment gave Buffett more capital to invest. The business was literally funding its own growth. Traditional companies need bank loans to expand, or they issue stock and dilute shareholders, or they reinvest profits slowly over time. Buffett found a way to grow without any of those limitations. The insurance customers were essentially giving him free loans, permanent capital with no interest payments, no repayment schedules, no covenant restrictions, just pure investment ammunition. National Indemnity generated maybe $2 million in float initially. Nice, but not revolutionary. Buffett needed scale to make this strategy world-changing. That's when he spotted Geico. Berkshire began buying Geico stock in the 1970s, when the company was struggling from bad underwriting decisions, and eventually acquired full ownership in 1996. Geico had millions of customers and massive float potential that would transform Berkshire's capital base. Picture the transformation. Geico collected premiums from millions of drivers every month. Massive cash flows pouring into Berkshire's investment accounts. Buffett now had billions in float to deploy however he wanted. The math became staggering. If Berkshire earned just 10% returns on that float, they'd generate hundreds of millions in investment income. more than enough to cover insurance losses and still deliver spectacular profits. But the real magic happened when Buffett used float to buy other businesses. Each acquisition generated its own cash flows, more money to invest, faster growth. The insurance companies weren't just profitable, they were acquisition machines, self-funding expansion vehicles that grew stronger with every purchase. Think about it. Most companies can only grow as fast as they generate profits. Berkshire could grow as fast as they could find good investments. The float removed traditional capital constraints. Every business they bought generated cash. Every premium dollar created more float. Every investment return compounded the wealth creation. The flywheel was spinning faster and faster. Berkshire's float grew from millions to billions over the decades. The insurance businesses often broke even on underwriting, sometimes lost money on claims. But the float generated such massive investment returns that the overall profits were extraordinary. Buffett had found the Holy Grail, a business model that gave him permanent capital to invest. No debt payments, no maturity dates, just endless opportunities to compound wealth. The secret behind Berkshire's insurance strategy? Float provided permanent capital to fund acquisitions without external financing. Other people's money became the engine for building one of history's greatest fortunes. But having unlimited ammunition was only half the battle. Buffett still needed to prove he could hit the right targets. His next move would either validate this entire strategy or expose a fatal flaw in his thinking. In 1972, Buffett paid $25 million for See's candies. Wall Street laughed. They didn't understand what he was really buying. See's looked expensive by every metric that mattered to investors. The price was 3 times book value. Revenue multiples seemed crazy. Traditional value investors called it overpriced sentiment. But Buffett saw something different, something that couldn't be measured in spreadsheets or calculated with formulas. He saw a brand with real pricing power. See's wasn't just another candy company. Walk into any California home in 1972. Open the kitchen cabinet. You'd find a white box with elegant black lettering. See's Candies. The same box their grandparents bought. The same chocolates their parents shared on special occasions. This was more than candy. This was California tradition wrapped in tissue paper. The company started in 1921 when Charles See opened his first shop in Los Angeles. His mother's recipes, his commitment to quality ingredients, no preservatives, no shortcuts, just pure chocolate crafted the old-fashioned way. By the time Buffett discovered them, See's had become woven into California culture. Birthday gifts, holiday traditions, date night treats, generations of families who wouldn't consider buying chocolate anywhere else. Think about what that loyalty actually meant. See's customers didn't shop around. They didn't compare prices. They didn't switch brands when competitors offered discounts. They just bought See's year after year, decade after decade. This customer behavior revealed something powerful. See's could raise prices without losing sales. Brand loyalty created pricing power that customers actually accepted. Here's where it gets interesting. Most businesses face constant price pressure. Customers demand discounts. Competitors undercut margins. Walmart forces suppliers to cut costs every year. See's experienced the opposite. They raised prices annually. Customers accepted it, even expected it. Premium chocolate deserved premium pricing. This pricing power generated incredible cash flows. Every price increase dropped straight to the bottom line. No additional costs, no extra marketing, just pure profit flowing into Berkshire's accounts. Buffett had discovered what he'd later call an economic moat, a competitive advantage so strong that rivals couldn't cross it. See's brand loyalty protected them from competition better than patents or regulations ever could. Try to compete with See's in California. Open a chocolate shop next door. Offer better prices. Use fancier packaging. Spend millions on advertising. None of it mattered. See's customers stayed loyal. That moat wasn't built from marketing campaigns. It was built from decades of consistent quality, childhood memories, family traditions, emotional connections that couldn't be replicated overnight. The financial results proved Buffett's theory. See's generated massive cash flows year after year, money that Berkshire could invest in other opportunities. The candy company became a cash machine funding the entire empire. By 2019, that $25 million investment had generated over $2 billion in cumulative profits, an 8,000% return that kept compounding. But the real lesson went beyond the numbers. Buffett learned that paying fair prices for exceptional businesses beat buying mediocre companies at bargain prices. Quality mattered more than cost. This insight transformed his entire investment approach. Instead of hunting for statistical bargains, he started seeking companies with sustainable competitive advantages, brands that customers loved, businesses that could raise prices without losing sales. See's taught Buffett to look beyond balance sheets, to value intangible assets like brand loyalty and pricing power, to appreciate businesses that grew stronger over time instead of cheaper with age. The acquisition also revealed something about American consumers. They'd pay premium prices for products that delivered consistent quality and emotional satisfaction. Brand loyalty could be more valuable than cost savings. Buffett later used that See's cash flow to fund more acquisitions. The candy company became proof that paying up for durable pricing power could generate extraordinary returns, which meant Buffett was ready for his biggest test yet. A bet so massive it would either validate everything he'd learned or destroy his reputation forever. In 1988, Buffett began buying Coca-Cola stock and ultimately invested $1.02 billion to acquire roughly 7% of the company. The investment world thought he'd lost his mind. Picture Warren Buffett in his Omaha office. Stacks of annual reports covering every surface. He's studying Coca-Cola's financials for the 100th time. The stock has been dead money for years. Most investors have written it off as a mature company with nowhere to grow. But Buffett sees something different. Something that makes his hands shake with excitement as he reaches for his phone to call his broker. Coca-Cola's stock had been flat since the early 1980s. 7 years of going nowhere while the market soared. Growth investors ignored it. Value investors couldn't find the bargain. The company looked tired, stagnant, a relic from America's past. Wall Street analysts were brutal. Limited growth potential, saturated domestic market, peak cola consumption. The reports all said the same thing. Coca-Cola's best days were behind it. Most investors saw a soda company. Buffett saw the ultimate global brand. Here's what everyone else missed. While America was drinking less cola, the rest of the world was just getting started. Billions of people had never tasted Coca-Cola. Entire countries where the brand was still exotic, still aspirational. Buffett focused on Coca-Cola's global expansion potential into developing markets rather than US domestic stagnation. The numbers that others ignored told a clear story. International sales, emerging market penetration, per capita consumption in developing nations. Coca-Cola wasn't mature. It was on the verge of explosive global expansion. Think about what Coca-Cola represented in 1988. American culture in a bottle. Hollywood glamour. Western prosperity. The American dream distilled into 6 ounces of sugar water. Countries opening to capitalism wanted everything American, starting with Coke. But Wall Street couldn't see past quarterly earnings reports. They focused on declining US sales, shrinking market share, competition from Pepsi. All the wrong metrics for a global expansion story. Buffett started buying quietly. accumulating shares while analysts recommended selling. His conviction never wavered. His analysis never changed. Coca-Cola was going global, whether Wall Street believed it or not. The financial press called him crazy, but Buffett kept buying. Month after month. Patient accumulation while the stock stayed flat. Then, the Berlin Wall fell. The Soviet Union collapsed. China opened its economy. India embraced capitalism. Suddenly, billions of new consumers could buy American products, including Coca-Cola. The international expansion happened exactly as Buffett predicted. New bottling plants in dozens of countries. Marketing campaigns in languages most Americans couldn't pronounce. Coca-Cola trucks rolling through villages that had never seen carbonated beverages. The financial results were staggering. International sales exploded. Profit margins expanded as fixed costs spread across massive volume increases. Currency translation added even more gains as developing economies strengthened. Coca-Cola's stock price reflected the new reality. What cost Buffett $1.02 billion in 1988 was worth over $11 billion by 1998. A tenfold increase in one decade. Returns that made every skeptic eat their words. But the real magic was deeper than stock appreciation. Coca-Cola produced both appreciation and steady dividends that Berkshire reinvested, making it a cornerstone holding that kept generating wealth year after year. By 2000, Berkshire's Coca-Cola stake represented 35% of their entire portfolio, a single bet that had become their largest holding. The foundation for decades of wealth creation. Here's the twist nobody expected. The investment that looked most risky became Berkshire's safest holding. Coca-Cola's global moat proved impenetrable. No competitor could replicate 100 years of brand building overnight. The skeptics who called Buffett crazy learned a painful lesson. Sometimes the best investments look terrible on paper. Sometimes mature companies are just getting started. Sometimes $1 billion on sugar water makes perfect sense. This success proved that paying up for the world's best brands could generate extraordinary returns. A single decision that validated his entire investment philosophy. But this massive win revealed something even more controversial about Buffett's approach. While everyone else was spreading their bets across dozens of stocks, he was doing something that made traditional investors very nervous. Buffett was putting almost everything into just a handful of companies. Walk into any investment firm today. They'll show you pie charts, dozens of stocks spread across different sectors: technology, healthcare, energy, consumer goods, the gospel of modern portfolio theory. Never put all your eggs in one basket. Modern portfolio theory says you need dozens of stocks to reduce risk. Berkshire's portfolio tells a different story. Look at Berkshire's actual holdings. Apple became one of their largest positions in recent years. American Express, Bank of America, Coca-Cola. These companies dominate their investments. The top 5 holdings represent roughly 70% of their total value. Most investment advisors would call this insane, reckless, a recipe for disaster. What happens if Apple crashes? What if banking regulations change? What if Coca-Cola loses market share? Was Buffett taking massive risks, or did he understand something about risk that everyone else missed? Here's what Wall Street gets wrong. They think diversification reduces risk. Buffett thinks diversification creates risk. The risk of owning businesses you don't understand. The risk of mediocre returns from mediocre companies. Buffett's philosophy is simple. Diversification is protection against ignorance, not intelligence. If you truly understand a business, owning more of it reduces risk. Picture Buffett studying Coca-Cola's annual reports. He knows their bottling partners in every country, understands their distribution agreements, tracks their market share in developing nations. This isn't gambling. This is knowledge. Compare that to owning 100 different stocks. Can you really understand 100 different industries? 100 different management teams? 100 different competitive landscapes? Impossible. Deep knowledge of a few great businesses reduces risk more than owning many mediocre ones. But Buffett's concentration strategy faced serious scrutiny in 2023. ProPublica published an investigation based on leaked tax data. The allegations were specific. Buffett sold about $80 million in personal holdings during periods when Berkshire was also trading the same stocks. Johnson & Johnson, Walmart, Wells Fargo. These personal trades were small relative to Berkshire's multi-billion positions, but the timing looked suspicious. Critics questioned whether Buffett was using inside information, trading on knowledge of Berkshire's plans before they became public, profiting from his position as CEO while other shareholders stayed in the dark. The controversy shook Berkshire's reputation. Here was the Oracle of Omaha, the man who preached integrity and transparency, facing accusations of self-dealing and ethical lapses. Charlie Munger defended his partner. He publicly said he didn't believe Buffett acted to enrich himself unfairly. Strong words from someone who knew Buffett better than anyone. But the damage was done. Questions lingered about whether concentration creates temptation, whether managing billions gives unfair advantages, whether the system itself encourages conflict. Here's the twist nobody expected. The controversy missed the bigger picture. Why would Buffett risk his reputation for pocket change? Why jeopardize decades of trust for insignificant profits? More importantly, the long-term results speak for themselves. Between 1965 and 2023, Berkshire delivered compound annual returns of about 19.8% versus the S&P 500's roughly 10.2%. Concentration didn't create disaster. It created extraordinary wealth. Think about what this means for regular investors. The financial industry wants you scared of concentration, scared of putting too much money in your best ideas, because fear sells products, mutual funds, index funds, diversified portfolios with guaranteed mediocrity. But what if the opposite is true? What if concentration on your highest conviction ideas actually reduces risk? What if knowing a few businesses extremely well beats owning many businesses superficially? Berkshire's track record suggests it does. Decades of outperformance through concentrated investing. Proof that knowledge trumps diversification every time. Buffett's concentrated approach worked because he understood something fundamental. Success isn't about avoiding all risks. We all fall down at some point. The question is, will you get back up? It's about taking the right risks based on deep knowledge and conviction. But this entire journey from failing textile mill to investment empire reveals something even more profound about transformation itself. Berkshire's story proves that sometimes the worst decisions create the best outcomes. Identity isn't what you were, it's what you choose to become. Ask yourself what product, process, or identity is holding your business back, and be willing to repurpose the brand. By August 2024, Berkshire Hathaway's market value surpassed $1 trillion, making it the first non-technology company to reach this historic milestone. The textile mill that almost killed the company became the foundation for one of history's greatest business transformations. The biggest mistake taught the most valuable lesson. Sometimes you have to let go of everything you were to become everything you could be. Which part of your business would you be willing to shed to transform everything? Comment below.